Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. We are doing, Rob and I of the Mindfull Investor are doing another podcast for you guys. Today, the topic is options. So, stock options, and we're going to try to give you a little bit of a background, and then each of us has a different way of how we work with options and how we make money off of options. So we're going to go through that and introduce everybody. So here's Rob.
Yep. Hi, Alesh. Thanks for having me again.
Rob, let's hear your process. I'm excited to hear.
Yeah. Like yourself, I mainly sell the puts and call option contracts. I sell maybe 90% of the time, and then sometimes I do like a hybrid. So like simultaneously, I can sell and buy a certain um option contract of an underlying asset. So let's say for Apple, sometimes I can sell a put and buy a call at the same time. And like there are so many different strategies in the options game that it is whatever floats your boat. There's so many strategies, but ultimately you can just sell your puts and sell calls. That's you can make like a lot of money just doing that. All the extra things you just pay more commissions. Like there's a play as Alesh and I was talking about before is Iron Condor. So you're selling two contracts and you're buying two contracts on this one play. And if we're using like Q trade, like Alesh is using, like that eats up like $30 just from commissions, but not that's not counting like penalties if there are any. Like that stuff is more advanced. So if you're more of a beginner, just like get to know the selling portion first, because that's the odds are on your side with that selling options game. So as I said, like sometimes I buy the calls or buy the puts, and those are normally not hedges. Those are like my home run plays, I call it. So if I make the play, I expect to get the 3 to 5x, or is all down the drain. It's either 1 or 0. Either I go 3 times or it goes to 0. But I'm not always making these plays. I spot opportunities, and maybe I see things that the market doesn't see, or maybe I'm really bullish on like certain earnings, or I feel that there's a bubble somewhere, let's say in the EV sector. Just like last month or so, a lot of the EV stocks, the China ones, they dropped 50%. So I put a bet on the put side, and I think that wasn't too much as like the 2.5x, because the volatility, the implied volatility of the stocks is like huge. So so there are people who are betting like on a huge crash. Let's say for Tesla, it was at $900. Even if you sell the puts at $100, you still get premiums. Like that's the volatility that these EV stocks has. Like it can go down 90, 80, 90%, and there are people betting on that. So
Right.
and yeah, so I do a hybrid, and yeah, so sometimes I think overall you shouldn't to make many of these buy call buy puts, because I think you only win maybe 10% of the time. That's like the inverse of the selling puts and calls. So if you only win 10% of the time, you have to make it worthwhile. Like if you're firing 10 bullets and only one of them gets 3x, overall you're still losing. So yeah, it's not for beginners for sure. So it's more like gambling.
It is a little bit, yeah. The thing about options is that if the stock makes goes up 10%, the option might go up 30%. But the problem is that, well, your gains are 30%. Uh, the option price will likely go roughly the same amount as the actual stock. But the thing is, everything is multiplied with options. But if you're not right within that expiry date, then you end up losing everything, and your option is worthless if you bought it. So, as with options, you basically have to be right, and you have to be right within a certain period of time. So, yeah, yeah, you get bigger returns, but bigger risks that you're going to lose everything. So it is a bit of a gamble. It is a bit of a gamble.
Yeah, and as I said, like I make some other plays. So selling naked calls is really risky, right? So there is like a hybrid. It would be called bear call spread. So you have to buy and sell calls under a different strike price. There's like a hybrid of it. I made videos on this if you want to check it out. I can't really explain it, but right now. But if you implement that, you kind of cap your max losses and you kind of know your max gains even before entering the trade. So let's say if I that's one of my plays I think a couple of weeks ago on GameStop. I was shorting at 300. I'm saying there's no way it's going to go past 300, but I put an insurance on it. So there's a hybrid play at the bear call spread. So once I implemented that I capped my losses to like maybe $5,000, but my max gain is like 1,000. So if you have that laid out on the table, it's like a 5-1 bet, and then you say, "Oh, am I willing to be on this side to lay down my $5,000 to win that $1,000?" But let's say on Alesh on the other side, he's like, "Oh, I'm willing to take that bet. I think GameStop is going back to the moon," so he takes that bet. So in a sense, I'm just betting with him that so he puts $1,000 on the table, and at the end of the month, we see who wins. And it could be somewhere in between. That's like I only lost maybe 3,500, and they made whatever. But overall, it's a zero sum game. So yeah,
Yeah, sometimes I think of options as just using the stock as sort of a random number generator, and you're making bets just like at the casino. If you come out ahead, good for you. There's kind of a theory that you want to make limited bets. You don't want to make big ones, because with big ones you could blow up your portfolio and basically not be able to continue the game. But if you make small ones and you're right 80% of the time, like I was 82% of the time mine expired worthless, then you're able to continue playing and hopefully make money. Uh, but I think what you're saying, Rob, is you're able to hedge your bets. So so with the example of stock prices here, and I'm going to sell a put down here. So if the stock keeps going down, 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 I'm losing a whole bunch of money theoretically. So what I can do is I can start profiting from that downward trend by buying a put maybe down here. I sell something here, I buy something here, and the one down here protects me from further losses. And also, I'm actually positive cash flow, because the one that I sold here, I was able to sell for more than the one that I sold or bought down here. I'm sorry. So it's really easy to, to mix them up and reverse them. And so that way you're protecting yourself. Uh, so there is a lot of different combinations and strategies, and everybody has their favorites. And you can say, okay, I think this stock is going up, so I'm going to use this strategy. I think the stock is going to go down, but not much, so I'm going to use this strategy. Others say, I think the stock is going to be really volatile, so I'm going to use a strangle, which is yet another strategy. So it's the amount of tools at your disposal is amazing. I think everybody, and Rob, what has been your experience? Does everybody sort of adopt a couple that they get really familiar with, or do you have 20 that you kind of use at any time?
Yeah, I think the total number of like option play names is like 40. But then like even myself, I create some new ones. So
Yeah,
like sometimes you just pick and choose what works for you. And I think what Alesh is doing, like tracking with a spreadsheet is very helpful. So let's say if all his covered call plays are usually doesn't perform as well, then maybe he wants to make more of the short puts, right? He wants to sell more puts. Like it's really unique to your investing style and your experience. So I think keeping track would be good. Another advice or another comment would be maybe put like a comment column on the rightmost side of the spreadsheet that like let's say for your Afria case is like, oh, like this is what happened, this is what I could have done better, or something like that, or some reflections.
oh, I was out $5,500. I remember very well what happened.
Yeah, but like 3 years down the road, maybe you want to backtrack. It's like, oh, that's how like we learn from our mistakes.
Yeah.
But yeah, so I think there's different styles. Like LS uses the option play website to gain some, I guess, insights. But
Yeah. What's your
yeah, there is so many tools out there, and just just try it out. But then you can always do it with a paper trading account if you, and then just see how everything affects the premiums. Because like the implied volatility is so many events. It could be macro events, it could be micro events, it could be like certain announcements from like a competitor's company. So, and one example is like Nvidia. They announced like they are going to make CPUs, and then instantly their stock price jumped 5%. But then their competitors, the AMDs, the Intel, they dropped 5%, like out of nowhere. So if you know that kind of event is like going on, maybe keep an eye on it. Like it could be very profitable, and yeah, you need to do some research on that
uh,
stuff.
for sure. Apologies, I sort of interrupted earlier. So before you put on a trade, what's your process? What do you do?
Before I put on a trade, well, you have to, most of the time, I need to have conviction on the stock to sell puts. But sometimes I really don't want to own the stock, but I see some kind of opportunity there that I feel that the stock or the market sentiments on the stock is like bearish, and I kind of make it play that way. It's uh an example would be Neo is like really volatile China EV stock. So I think the high for this year is like 60. When it dropped to 40, I'm saying that there's no way it's going to drop to $20. And then that's when I sell like a lot of puts, just naked puts, but I didn't want to own it. And that's why I placed it at $20. It's like dropping another 50% from $40. So from as high as $60 to $20, that's like dropping 67%. That's an absolute meltdown. And I was betting that it wouldn't. I was betting that it would just taper and maybe bounce back slightly. As long as it doesn't break that $20 mark, I collect all the premiums. So that's like one of my plays. It's to sense if there is like a lot of fear in the stock, because a lot of fear or a lot of greed will increase implied volatility, the IV, which
Mm.
increases the premiums, which makes it worthwhile for me to sell them and collect like higher premiums.
Yeah, so that's a different mindset, and it's completely valid. So as we were talking about, some people actually want the stock, whether to sell covered calls or to sell puts. They wouldn't mind getting the stocks. Other folks just trade the options, and they don't want the stock. And so like I did that at the beginning. Is I would sell a put because it was a high premium and a high return, but then I ended up getting a crappy stock, which just kept going down. So eventually I sold it at a loss, and I'm like, okay, well, that premium definitely wasn't worth it. So I think that just happened once, and then I stopped doing it. So from then on out, I said, okay, if you're going to sell puts, do it on stocks that you wouldn't mind holding. So like one of the ones I have outstanding now that I ended up getting, and now I sold a covered call on um, is Lithium American Lithium, and so I'm like, that sounds good. Batteries, sure, let's do that. So I didn't mind getting it, but I also wouldn't mind losing it. So that's why I'm selling the covered calls. But at the beginning, just I sold puts on stuff that I didn't want, and it wasn't great. Conversely, in order to sell a covered call, I also ended up buying upfront a stock that I didn't want, and then I sold the covered call on it just so I could get the high premium. And then the stock goes down again. Yeah, sure, you got a nice premium, but now you lost more by the stock going down. So even in a fairly conservative strategy, you there's bad things that can happen. Conversely, if you want a stock and you sold a put, but the stock kept going up, then you're like, well, if I had bought it outright, I would have benefited from it going up. Now I don't have the stock at all, and I wanted it. So uh, it's not clear, right? Like it's not a 100% win. To me, uh, there's definite risk and there's definite downsides. And I always say you have to be right. You have to have the right direction. And that's tough. That's tough. Also, when I started in June, we had sort of an upwards trending market, so it wasn't that tough to have puts expire worthless again and again. So, anyways, so what sort of research tools do you use, Rob?
Research tools. I think a little bit of technical analysis. You just pull the 1 month, 3 month, and different moving averages, and then just spot the local bottoms and tops. That's just a reference.
Okay.
But then you kind of, I don't know, I gain it from market sentiments. So, so
Okay.
and I play on the opposite side. So if the market is crashing down 10%, it's a good time to sell puts. Like in my book. But a lot of people be scared, and then they'll be, yeah, they just wait out and wait for the trend back upwards before they sell puts. But then by the time it bounces back the other way, there's no more premiums.
Yeah.
Like, like
Yeah.
I'm there for the premium, so I want the volatility.
Yeah. As the stock is going down, the premium for the puts becomes higher and higher because it's getting closer and closer to the strike price. But if it expiring worthless is your goal, then yeah, that's not the best time to sell the puts. Um, yeah, you have to be right with the direction. That's kind of tough. Um, the other thing I was going to mention is when you're picking a brokerage, or when you're using a brokerage and you're signing up for the options, what I found was when I was filling out the questionnaire for the margin account and for the options trading, I put myself as being a beginner in options. And then what my brokerage did is they set up the accounts for me, but they only let me do covered calls because there you can't really lose generally. So that's kind of the safest. But then when I wanted to sell cash covered puts, it wouldn't let me. And then so there were multiple phone calls with my brokerage with Q Trade. It's like, no, we're trying to save you from yourself. And I'm like, okay, I know what I'm doing. Can you please enable that? Well, you have to fill out the forms again. filled out the forms again, and they created another set of margin accounts for me. Now, this is actually 4 accounts because with that form, they create a Canadian margin, a US margin, a Canadian short, and a US short. So I already had those 4 with no permissions, and then they created another 4. So then it was more phone calls for them to drop the first ones and consolidate things, and it was just a pain. So what I would suggest to anybody who wants to start in options is educate yourself, watch YouTube, watch Rob's channel, do a lot of reading, and then you can truthfully say in the application, I am an expert with options, and then they will give you all the permissions, and hopefully you're, smart enough not to blow yourself up with something. The other thing is check what your brokerage can actually do. So some of the techniques that Rob has been talking about are 2 legs, where you sell one and then you buy another one in order to offset your risk. Or there's an iron condor where it's actually 4 transactions and you want them all to happen at the same time. And with Qtrade, those would be 4 separate transactions, which I would have to put in separately, execute them separately. But other brokerages, they let you pick from a pull down. I want to do an iron condor, and it pre-fills 4 transactions, and then you just fiddle with the numbers, you press, and then it does it all for you all at the same time. So I would heartily recommend, if you want to do some of these more complicated transactions, to pick a brokerage that allows them to be done all at the same time. Qtrade is okay for me because I only do the one and I take the risk, and so far, knock on wood, it's worked out. But I wouldn't be satisfied with Qtrade doing these things one at a time if I was doing some of the more complicated ones. So
Yeah, it's really important that when you execute the multi-legs, you need to do it like at the same time, because sometimes let's say you do one at a time and then you say, oh, it looks like a good price, and then you execute one, and then you look at the other one, it's like, oh, it looks really expensive. But then after a couple of minutes, the stock price fluctuates like 2%, and then all your profits would be gone already, and then you still have to lock in that trade.
Yeah.
Because it's like working simultaneously, right? You can't just do one leg. It's a different play.
Right. And not having done it myself, but I understand that there's nothing more frightening where you have the sold covered call and you're not able to buy the other call further up.
Yeah.
To cover your risk. So that's definitely something to be on the lookout for. And my Afria example there. So if I had bought, so I sold the call at $8. If I had bought a call at 10, and then of course the thing ended up going to 14, I would have been benefiting between 10 and 14 from that other call. So you try to do them in pairs. That's a vertical spread. That's a very standard thing. And anybody who's taken official training, I think these are techniques which are drilled into people, and everybody does them automatically. I would think, right, Rob?
Yeah.
So
yeah.
Okay, well, I think we sort of covered everything we wanted to about options and our various strategies. It's an exciting world. It's a high octane world where you get a nice multiplier onto everything, and getting a 30% annualized return on options isn't unheard of. But there's always a risk price to be paid. So do be careful. And like I said, I quickly learned to only deal with stuff that I wouldn't actually mind holding. But yeah, Rob's kind of gone above and beyond that by making money off the options themselves. So it's kind of 2 different ways of looking at it. Any kind of last thoughts, Rob?
Yeah, I think if anyone is to start, just just start really small. Just start with like one contract because you need to feel the ins and outs and know how you can win and how you can lose and how much you can lose. Like treat it as like a long game because like don't get too aggressive. Let's say if you were really bullish on a certain stock, let's say if you're really bullish on Tesla or something, like don't bet everything on a call that expires a month away because you believe the earnings is going to blast off. Like if you think that way, a lot of other kids would be feeling that way, and that's how like me playing on the other end, I'll be selling the calls to you because I don't believe that the stock would jump, it would double in 1 month. And just treat it as a long game and just bet small, learn to win before you lose everything.
Yep.
Yeah.
Yeah, don't make big bets. The seminars that I've been listening to, they say only risk 2% of your portfolio on a single trade. Uh, that way you can keep going, because if you lose the 2%, it's okay. But if you risk 30%, because you've been losing up until now and you really want to make up for it and you really believe in this one, that doesn't mean that it's actually going to come true. And you can blow up your portfolio and then you're out of the game and you can't make any more money in the future. So uh, yeah, you develop your own style, obviously. I'm always learning, and from folks like Rob and his videos, it's great to to get people who've been doing it and who've been profitable at it, and just keep educating yourself. Options, there's so many different strategies. It's not even funny. So keep learning. Well, thank you everybody for joining us. Hopefully you found this podcast useful and entertaining. So thank you, Rob from the Mindful Investor, for joining us. This has been Alesh Eisner from the Canadian Money Talk. Thank you very much.
Thank you.